What's going on, you guys? So in this video, I'm going to be going over my top 5 dividend-paying stocks for 2018 and kind of going into exactly why I like the companies and where I think the companies are growing in the future. Dividend stocks have been a really hot topic recently, especially ever since the market got really volatile again. A lot of you have come and asked me, like, what are my, defensive picks or what are my, like, hedges, quote-unquote, for the market. And honestly, if you're someone that wants to stay in the market, but you're kind of afraid of the volatility and you want to kind of, mitigate a lot of that, dividend stocks are pretty much the way to go. It's better than keeping your money in a savings account. Obviously, it's not going to be as if you're investing in high flyers and, really innovative tech companies that, are either going to go up or down 10% off their earnings. This is definitely a more of a passive way of investing and, kind of the slow and steady wins the race type of method, but can definitely lead to really large returns over the long term, especially when you incorporate, say, a drip and you reinvest your dividends and you get dividends on your dividends and your portfolio starts to snowball from there. So I know a lot of you are kind of interested in dividends right now, and I kind of wanted to just go over my top picks. If I was investing solely for dividends, what companies would I feel comfortable investing in? If you guys are new to my channel, make sure to like and subscribe if you like this type of content. I try to put out as many videos as possible, and, I just give my personal take on the markets and, different financial, approaches into my investing, and I kind of document it here on YouTube. So if you're interested in any of that, make sure to stick around. But without further ado, let's jump in the video. So the first company right now is McDonald's. Now, McDonald's doesn't really need much of an introduction, I'm sure. McDonald's is a dividend aristocrat. It's been almost 50 years of raising its dividend. It's the largest real estate company in the world. And for those of you that don't know, McDonald's is pretty much a real estate company. McDonald's, the reason why it's so much more profitable than the majority of other fast food chains is because McDonald's has actually gone around and purchased, the building and the land of all of their franchises. They've licensed it out, so not only are they getting, the royalties from the franchises making the products, they also get all of that appreciation and, rental income. So that's why McDonald's gets hit a lot less, in a recession compared to other fast food chains. And also, fast food is technically an inferior good. And if you take in economics, inferior goods do significantly better than the rest of the market during a recession. And that's because generally, people know that it's not good for them, but it's much cheaper in the short term. So they just go with it, and then they don't really care after that. They're saving a couple bucks. It's quick, it's easy, it tastes decent, and they just go on from there. McDonald's is also interesting because it's not only just an inferior good and it does pretty well in recessions, it also generates a lot of money in bull markets. So if you look at McDonald's revenue over the past couple of years, our economy has been going up, and McDonald's, a company that, most people look for as, say, like a safe haven away from a recession to, cushion the impact, has been making a lot of money and has been, outperforming the market over the past few years. So McDonald's is definitely not, sleeping, quote unquote, in a good market, which is really interesting. And then something that is just kind of my personal opinion and my kind of viewpoint on the market right now is that millennials and people under our age cannot cook to save their lives. Living in college, especially when I was in the dorms, I saw firsthand at how bad people actually were able to take care of themselves. People were pretty much raised from Google, and anything outside of that, anything that's handy and whatnot, a very few percentage of us actually know how to take care of themselves, and it's kind of sad, especially right around that 18-20-year-old range. I fear for a lot of people when they start living on their own and start cooking. So just funny tidbit there. I definitely think McDonald's is not going anywhere soon. They pay a 2.5% dividend yield right now, and you definitely don't have to worry about it. So that's why they're my first pick. My next pick is going to be Pepsi. So Pepsi, a lot of people are generally, go to Coca-Cola whenever they think about dividends. And I definitely think that Coca-Cola is, the dividend king, let's say, over the past 50 years. But I do think Pepsi over the next, say, few decades is going to dethrone them unless Coca-Cola significantly, redoes their infrastructure. And my main reasoning for that is they both pay, over a 3% yield. They both have continuously grown their dividends over long periods of time. There's definitely no question that these companies are focused on their dividends. However, I do think Pepsi is positioned much better for the millennial and future generations because it has a much better portfolio of brands, in my opinion, than Coca-Cola does. And I think Coca-Cola was great for baby boomers, but I think the majority of millennials do enjoy Pepsi products more. And that includes Mountain Dew, Quaker, Frito-Lay, Naked, Gatorade. a bunch of other brands, Pepsi is definitely going on the more, you know, still junk food, but also junk food with healthy alternatives route. And I think that's making them much more, you know, less susceptible to all the consumer trends changes, you know, from years to come. People learn that how bad things actually are for them. More people are getting educated. Less people want to be eating, you know, just crappy food all the time. And also, Pepsi over the past few years has had an amazing dedicated management, especially their CEO that just stepped down, Indrid. She was completely focused on Pepsi over the long term and focused on the stock dividend. She was not really focused on, you know, pleasing people on quarter-to-quarter earnings. She was focused on, you know, having investors keep Pepsi in their portfolio for their entire lives, count on it for their retirement. And I think that that was exactly what a CEO should be doing, especially when you have a mature company like Pepsi. So I love Pepsi. I love what they've done with the company, and I think it'll outperform Coca-Cola over the long term from here on out. Assuming Coca-Cola doesn't rapidly change its portfolio, which you never know it could do. Next is Altria. Now, so Altria is definitely, you know, not a company that a lot of people like to be invested in. And honestly, it's something that you really have to think about. Like, are you comfortable with putting your money into a company like Altria? So Altria, obviously, they make cigarettes, and they're the parent company of Philip Morris. And so they are focused primarily on just the U.S., and, you know, they're a dividend aristocrat. They're a consumer staple because whether economic times are good or bad, people still go out and smoke. You know, generally if you smoke year-round, you know, pack or so a day, and you're going to continue smoking regardless of economic times. And, you know, they have a very steady flow of income because of that. They also have very sticky margins. And so a lot of people say that, okay, the cigarette industry is dying, less people are smoking tobacco. And that's pretty much been fine, at least for the major tobacco companies, because all that they do is they raise their prices. They know the people that currently smoke are going to continue to smoke, so they're able to just kind of become more and more profitable. Their overall, you know, say consumer base goes down, but their actual revenue and their earnings are going up. So that's something to keep in mind. Altria also is pretty diversified even within the tobacco sector, because Altria owns 10% of Bud and also owns its own wine company. And so Altria is kind of mixed in not just, say, cigarettes, but also in alcohol. So that gives it more of a diversified, you know, approach into even consumer trends changing. And you also got to think that, you know, Bud, as long as Bud continues to pay its dividend, Altria is going to be getting a lot of revenue from that. Bud did, I believe, just cut their dividend, but Altria, you know, if you're looking at it for the long term, I definitely can see Budweiser continuing to pump out more money and increase that dividend again, you know, over the next few years. Also something that, again, is kind of more of a secular trend and something that is, you know, a macroeconomic phenomenon that right now is kind of terrible as far as consumer lives go, but it's amazing for companies like Altria, and that's just the way it is. You know, it's not a good thing. I'm not saying it's a good thing, but that just happens to be something that's happening, is that 25% of high schoolers currently vape, and most of them vape nicotine, and over 30% of these, I didn't finish it there, 30% of the current high schoolers have switched to smoking either cigarettes, hookah, or anything else that uses tobacco within 6 months of starting vaping. And so this is a really bad epidemic, and unfortunately, you know, mainly because of the company Juul, so many kids now are smoking and vaping. The FDA is actually looking into, you know, canceling all these marketing ploys for kids, which I think is an amazing idea, because definitely we shouldn't be having kids smoking or vaping. But if, say, that does happen, I think a lot of the market share in the future, you know, innovation is going to be going to Altria and the other big tobacco players, because, you know, they have the money to be able to, you know, adapt to consumer trends. Assuming, you know, if people are like, well, vaping is a lot healthier, say, than smoking, and, you know, if people do want, say, that nicotine buzz, you know, vaping is the better way to go. You know, it's better, obviously, to do neither, but if people are going to do it, people are going to be vaping, and I think Altria is positioned well to capitalize on it if they want. And also, on the whole marijuana front, definitely Altria, if they ever want down the line, can definitely capitalize on marijuana. You know, it's pretty easy transition if Altria just wants to get into that space, assuming, obviously, I don't think they're going to be until it's federally legal, but once it's federally legal or Altria gets the A-OK, I can definitely see them dumping a few $1 billion into that and becoming the world's leading cannabis company almost overnight. So that'll be really interesting to see how that plays out. But they do pay a 4.9 dividend yield, and I can't really say much more about this. Like, this is definitely a cash-generating company. but not a lot of investors like to invest in these companies because it's a sin-based company, and not a lot of investors like to have that on their conscience. So I'm not recommending any of these stocks, but I'm definitely not recommending Altria. So that's just something, if you guys are just purely looking for revenue, that is the way to go. Next is going to be Starbucks. So Starbucks is kind of interesting. So Starbucks is the only company so far that is not a dividend aristocrat. However, over the past 7 years, their dividend yield has been growing at over a 20% rate. Some years it's been going up 40%. They have one of the strongest international brands. I am a shareholder of Starbucks. You all know this. And I'm doing very well in that position, thankfully. But see, Starbucks, my philosophy kind of stays the same, is that Starbucks has a strong international brand. They have a really good management team. Bill Ackman's also coming in, and they're rearranging their management team now that a couple of their key members are retiring. And I think they're executing very well. People that have run other extremely successful companies and that there have been executives for 20 plus years are stepping in to help Starbucks really take off in China. I think everything's going well. They're extremely profitable. They're probably the most profitable coffee chain in the world. They have extremely high margins because they have such a premium product, and people are willing to pay for that premium that they know and that atmosphere. Coffee shop buying and, just people going into, say, a coffee shop, trends are at an all-time high. That's been a secular trend even through the last recession, that just more and more people over time are doing that. So I definitely think that more and more people are going to, say, go out and buy a cup of coffee than, say, they are 20 years ago when people just generically made their own coffee. Like, I personally make my coffee in the morning, but that's not what the average person's doing. And I think you definitely need to keep an eye on consumer trends when you're looking at dividend-based companies, especially when you're looking out, for the next few years. And obviously huge potential growth for Starbucks in emerging markets. Bill Ackman is speculating that he anticipates over the next few years that, based off the extra revenue that Starbucks gets from just China alone, that it has the ability to double or triple the company. So that's talking about, share price of well over $100. And so that'll be really interesting to see kind of how that plays out. When he started buying the stock was around when I did. So that's about, the high 40s, low 50s. It's still a decent buy right now, but definitely, him and I are up, I think, almost 40% now off of that. So, we have I think it's close to a 4% yield. So, Starbucks has been going really well. You can definitely expect this to take a hit, during a recession, but I do think this company is here to stay, and I think their dividend is here to stay. So that's why they're on this list and one of my favorite companies to look for in a dividend. And last is another non-dividend aristocrat, but it is Microsoft. So Microsoft is like Starbucks. It yields a relatively small dividend right now, but it's been growing at a relatively fast rate. It's been 10% over the past 10 years, and I think in recent years it's been closer to 15%. But Microsoft has a pretty much impenetrable moat. You cannot really replace Microsoft. Microsoft has solidified itself. It is the PC go-to, almost 90+% of the, market share of, say, companies and things like that use Windows. They don't use Mac. Obviously a lot of you users probably use Mac, or you're watching this on a Mac. And I'm not saying that anything against Apple or anything like that. There's just a clear sheer numbers, favor of Microsoft over Apple as far as the computer goes, and obviously not many people are just gonna start and open up an OS to compete with either one of them. Companies have in the past, and they just get bought out or they fail because they're not profitable and no one goes to them because you have no developers for it. So Microsoft's pretty rock steady for being a company for the next 100 years. Cloud growth has completely rejuvenized the company. It was pretty much flatlining, and now it's continuing to diversify its business, and it's projecting itself into the future. And even though it's a relatively slow grower now, it's only growing at about 12% past couple of years, and about 15 I think projected for the next few years. Microsoft, I can definitely see it getting back into the 20% range once cloud computing really takes off, once AI really takes off, and once gaming really takes off, because of their whole Microsoft company. And so I only see positive things for Microsoft. Do I think it's going to be an amazing high flyer? No. Do I think it's a little overvalued right now? Yes. I'm not going to lie about any of that. But I do think over the long term, Microsoft is a safe company. I think it's a company you can count on being around, and I think you can count on its dividend for years at a time. So that kind of wraps up my 5 picks right now for dividend companies. These were just kind of companies that I think either have an amazing moat, they pay a pretty good yield, or they have a really fast growing yield, and they're companies that I think that no matter what situation happens in the market, you can count on them being around, 10, 20 years from now. And if you take advantage of, say, a recession or, any DRIP program, you can make an insane amount of money over the long term with these companies, just because they're dividends. And that's the thing, like, growth is great in the short term, but realistically, if you want long-term wealth, unless you want to get really good at timing companies or, investing in companies for, I say timing, what I mean is you look for a company that's relatively, small, and you wait for it to explode over the long term. Honestly, not a lot of people are into that. A lot of people reference long-term, as a few months to a year, which is not really long-term. If you want to invest in growth for the long term, look at Peter Lynch. Peter Lynch's average hold was from 5 to 6 years. So people that, throw around long term a lot right now definitely aren't really in for what they think they are in for. So definitely, I think dividends are probably the most realistic option. If you're worried about the economy, I think dividends in strong, relatively fast-growing companies are the way to go. And again, this isn't financial advice. This is just and I know a lot of you are, kind of really skeptical of the market right now. You want to switch more into dividend stocks away from some growth stocks. So that's just it. Hope you guys got some use out of this. Hope you guys can see kind of like how I look at, dividend plays and really, what I look for in a dividend company. Let me know if you guys own any of these companies or if you guys own any other dividend companies and, kind of your reasoning for that. Hope you guys enjoyed the video, and I'll catch you guys in the next video. Peace.